barely a few weeks on from when Britain's housing market bears were starting to reappear on the scene in the mainstream press with perma doomsday headlines that followed February's 1.5% plunge, and on the back of news of a fast slowing UK economy. However, now out pops the Halifax with its latest data that shows average UK house prices have once more accelerated to above 10% per annum by galloping ahead by a whopping 2.6% for March, near double February's 1.5% drop, and despite February's drop are up by 2.9% so far this year, which converts into an annual inflation rate of about 11.6%. So what drove March's panic buying? Well, that would be the new 3% duty charge on investment properties, which I've been warning off for near 6 months would trigger panic buying in a mad rush to beat the start of the new tax year that has now materialised. The war on the UK buy-to-let property market sector is intensifying, and the latest bad news to hit the buy-to-let rental property investment sector was the announcement from the Bank of England to make conditions on buy-to-let mortgages even more stringent by going beyond the current norm of just mortgage interest being covered by the anticipated market rents. Instead, it has been proposed that at a minimum, rent should be at least 125% of mortgage interest payments, as well as taking into account all of the costs incurred such as repairs, tax and voids, as part of a continuing trend to make more properties available to first-time buyers that property investors have been busy buying up for well over a decade, that has resulted in making it near impossible for first-time buyers to get a step onto the bottom rung of the property ladder in many areas of the UK. In fact, I've been warning investors for over a year that the buy-to-let sector's days are numbered and far longer to avoid flats, and to expect a whole host of announcements that would seek to tax and penalise the buy-to-let sector into oblivion. So this should not come as much surprise to viewers and readers of my UK housing market articles and videos that even before the May 2015 general election warned of the forthcoming dire consequences for the buy-to-let sector investors, conditions that are only going to steadily get worse with each passing year as the political parties would increasingly seek to woo the 6 million strong army of private renters in the run-up to the 2020 general election. Therefore, the Conservative government is continuing to lay the property market groundwork for the 2020 general election, one of far higher supply for first-time buyer properties, all without significantly increasing the construction of new builds, as effectively many hundreds of thousands of today's renters become property owners, which paints a bleak picture for buy-to-let investors, as each year many new measures are announced that will chip away at profit margins until they turn into losses that mushroom into unserviceable debt mountains, and thus forcing investors to sell. So if you're a buy-to-let investor, don't stick your head in the sand and think things are going to get better. They are not. Instead, things are going to get much worse, and if your hands are already not very strong, then it may be wise to think about exiting before you are forced to sell at a significant loss. The current assault on the buy-to-let sector just confirms that ultimately the trend is towards a buy-to-let doomsday, that of the right to buy scheme being extended to private sector tenants. UK house prices momentum. The non-seasonally adjusted UK house prices momentum shows that after a post-election slowdown to 7%, momentum has once more steadily increased to an inflation rate of 11.1%, now at its highest rate since the last housing bull market. Therefore, the effective house prices momentum range is between plus 11% and plus 7%, which implies to expect an average annual house price inflation rate for 2016 of about 9%. Therefore, don't expect any follow through on March's surge higher to 11.1%, as the buy-to-let sector frenzy is now over. Instead, I expect house price inflation to fast slow to a more sedate pace of about 7 to 8% per annum. UK affordability crises. What the academics and mainstream press commentators persistently fail to comprehend is trend, or more precisely the trend in affordability. The trend over the past 40 years has been for the proportion of household earnings spent on housing costs to rise from about 20% 40 years ago to an average of 35% for December 2013, which is trending towards 50% by 2030. This is the big story that the academics have missed, or as over time, decades in fact, people are gradually becoming conditioned to spend more and more of their earnings on housing costs as being the norm, which is why the government subsidises through benefits such as tax credits and housing benefit. The reason why I expected affordability to trend ever higher again has its roots in the exponential inflation megatrend, as workers relentlessly face a loss of purchasing power of earnings and savings due to reasons such as the inflation of the size of the population that is mostly as a result of continuing out of control immigration, as evidenced by the baby boom now underway mostly amongst migrant families of the past 15 years that acts to relentlessly put pressure on housing availability, where annual construction new builds are not able to keep pace with even half of the new demand generated each year. Therefore, workers have no choice but to commit an ever larger proportion of their earnings towards housing costs, the effect of which is that housing bear market affordability troughs are being ratcheted ever higher, which has left many academics confused as they remain fixated on their theoretical models that imply house prices must fall so as to return to affordability levels of past troughs, as the real world trend passes them by and their models. The updated graph of December 2015 shows that the underlying relentless trend of affordability being once more ratcheted higher that looks set to breach the 2007 bull market peak during 2016, i.e. house prices this year will be even more unaffordable than they were right at the very peak of the last housing bull market. Also see my earlier housing market affordability crisis video. UK house prices forecast. In terms of the prospects for UK house prices, it is now over 2 years and 3 months since excerpted analysis and the concluding 5-year trend forecast from the then UK housing market ebook was published. Therefore, in conclusion, my UK house prices forecast is for the Halifax non-seasonally adjusted house prices index to target a trend to an average price of £270,600 by the end of 2018, which represents a 55% price rise on the most recent Halifax prices data of £174,671 for November. Again, note that this analysis in this video is merely an excerpt from the total analysis in arriving at this trend forecast, so do refer to my UK housing market ebook, which will be available for free download from the middle of January 2014. Current UK average house prices of £212,859 are currently showing a 3.6% deviation against the forecast trend trajectory, which if it continues to persist, then in terms of the long-term forecast for a 55% rise in average UK house prices by the end of 2018 would translate into a 9% reduction in the forecast outcome to approximately a 46% rise by the end of 2018. The bottom line is that house prices are going to continue to get ever more expensive, where those who are waiting for a crash to a more affordable levels will continue to regret not buying, as the only way housing can even start to become more affordable is if the UK literally triples the number of new builds each year, from approximately 140,000 per year to 400,000 per year, something that is just not going to happen, as it would literally mean the government committing to build a new major city every year. Instead, it has been over 40 years since the last new town, let alone city, was built. So in my opinion, I think it is inevitable that eventually the government will be forced to build a series of new towns that will grow into new major cities that should be announced over the coming years, which, whilst encouraging economic growth, will however also encourage further mass immigration. So even a series of new towns and cities may only make a marginal short-term difference to the UK housing market affordability ratios. And finally, a word of caution that whilst the bull market currently remains on track to run for several more years, nevertheless, don't forget that at the end of every bull market lies a bear market. Just as I warned in the months leading up to the August 2007 bubble top that the clueless mainstream press remained blind to for at least another year, with garbage headlines for a soft landing rather than the unfolding crash. And remember to subscribe to this YouTube channel for ongoing analysis and detailed trend forecasts.
Should old acquaintance be forgot and never brought to mind? Should old acquaintance be forgot and all lang syne? For all lang syne.